Welcome to another episode. My name's Jose Najarro, and today we are going to take a look at BMY's earnings, also known as Bristol Myers Quarter 2 2019. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company's doing. So let's get started. Before we begin, like always, I want to let you guys know all the information that I collected. I went through either BMY's investors website, their 10Q report, their 10K report, and I also used Seeking Alpha to get the information on transcript of earnings call and some other information that I found through there. Year to date, BMY, when I collected this, is negative down 2%. And over the past 52 weeks, is down actually 16%. So we got to see what's going on and see if it's worth investing right now. So right off the bat, the first thing we're going to take a look at is revenue. So revenue for this quarter 2 was reported on July 25th, 2019. So quarter 3 should be coming up in the next few months. Actually should be coming this month. So in the next few weeks. So it's good to get a refresh of how the company did. So quarter 2 non-GAAP earnings per share of $1.18 beat by 12 cents. So we have that beat, surprise, and revenue of $6.27 billion also beat by $170 million. Revenue was actually up 10% year to year. Those are actually really good numbers. And for that reason, first point is going to go to Bull Solo. Bull Solo's here taking the lead. One thing to note, if we do take a look at GAAP earnings per share, it was a miss by 12 cents. And that's something that we're going to talk about in the later episode of why that miss happened. All right, so the next thing we're going to talk about is comparable sales. So we're going to take a look at this quarter 2 compared to quarter 2 2018. So U.S. revenue increased 14% to $3.7 million in the quarter compared to the same period a year ago. International revenues also increased by 5%. Global revenues for the second quarter of 2019 compared to the quarter of 2018 were driven by these. So these are all the medicines they sell. I'm not going to act like I'm an expert in this, so I can't pronounce most of these, but we can see that Eli grew by $392 million, a 24% increase. Vivo grew by $196 million, 12% increase. Orencia grew by 9%. Spriso grew by 2%, and Yervoy grew by 17%. So that's pretty good. I mean, I don't need to learn how to pronounce these if I know they're growing at quarter to quarter and if they're collecting more money. And that's what they're doing. So here, right, we can see total revenue this quarter was $6.273 billion compared to last year, $5.7 billion. If we take a look at non-GAAP diluted earnings per share, this quarter was $1.18, like we mentioned, and last year, same quarter was $1.01. So we can see there is a huge increase in both total revenues and earnings per share. So we're going to end up giving a point to Bull Solo, but we're still going to continue discussing why the comparable sales increase. So here, if we take a look at these graphs, in the left, I have, it would be on my left. I think that's your right. So on one side, I have the 3 months of June 30th, 2019 for the past 3 months, or the past 6 months. So we're just going to take a look at the past 3 months, so that just only includes quarter 2 of 2019 compared to 2018. So we can see all these medicines have increased. But you know what I think I enjoy the most is we can see the first 2 medicines, which is Opdivo and Eliquis, whatever. Those 2 medicines make up about $3.8 billion of that $6.2 billion. So that's over half. That's about 53% of the total revenue is made by those two medicines. One thing to note is those 2, which are such a huge portion, have increased in the past 3 months compared to the same time last year. So right, we have Vivo, which is increased 12%, and we have Eli, which increased 24%. So that's pretty good to see. The big boys increasing constantly, right? Usually the big boys are the ones that remain flatline, but here we can see the big boys are coming in strong and they're getting stronger. And we can see all the other ones that make up still more small percentage of the total revenue, we can see they make up a little less than 10% or roughly around 10%. They're still increasing. We see a huge increase throughout the whole, all their brands. Then we're gonna see that there's two brands that are actually going down, and Barracuda is one. It's down 18%, but 18% down is not a huge deal because right, that Barracuda same time last year was only $179 million. So what's that, like 2-3% of total revenue, and it was down 18%. So it's still pretty much in the high singles. It's about 147. So yeah, about one. What is that? It's definitely the single digits of percentage. So it's definitely not a scary thing. Overall, like we've mentioned, revenue has grown 10%. So comparable sales are looking good for the company. All right, so next I just want to talk about the main brands that were affected throughout this past quarter. So I'm going to talk about the two losers, Barracuda and other brands. And I'm also going to talk about Opdivo and Eli Quiz, which are both the biggest hitters, the biggest gainers for this company. So let's start with Barracuda, one of the ones that's down 18%. And the main reason Barracuda is down is because there is an increase of generic competition. So obviously, if there's an increase in generic competition, more people are going to go to those opposed to the Barracuda brand. Other brands, which was also down, is down for the same reason. It lost exclusivity in major markets, so there has been more competition in over-the-counter brands and royalty revenue. So next we can see Eli, which was one of the biggest brands. Revenue increased due to market share gains within the oral market. So that's, again, pretty good. We can see Eli is increasing market share gains. That's one thing you definitely want to see with one of the big products. Unfortunately, Opdivo, which is one of the biggest, I think it was the second biggest revenue collected, making up about, I'm going to say, close to 30, a little less than 30% of total revenue. One thing to note is sequential reduction of revenue in recent quarter is due to lower demand in the previously treated advanced lung cancer market, and they expect this trend to continue. So if we take a look at Opdivo, we're going to see that in quarter 2 compared to quarter 1, it did drop down a bit, and this trend is going to continue to go down. So we can see, hopefully, this is a big hitter. So if the reduction continues, that's obviously going to affect revenue in the long run. So it's something to keep an eye out for quarter 3. All right, so some things to note. So gross margins as a percentage of revenue decreased from 71.5% to 68.2%. That's actually pretty good gross revenues for a company. We're going to take a look in the next episode how the overall margins of the company is doing, but that's, imagine, 68% is gross margins. And the main reason that there was a decrease from this margins compared to the same time last year was due to a product mix and $109 million impairment charge in connection with the expected sale of manufacturing and packaging operations in Italy. So right, they're telling you here the main reason, one of the major reasons for this decrease in gross margins was they had this huge charge of $109 million, and they're also due to a product mix. Another thing to note is research and development expenses decreased 45% compared to the same time last year to $1.3 billion. Due to same time last year, there actually was an extra $1.1 billion charge from collaborations with Nectar. So you can see, right, and if you look at just the 10Q report, you're going to be like, wow, this company is doing 45% less research and development, but that's not the case. It's just same time last year they had an extra charge from collaborations with Nectar. But if you guys want to do in the next episode, we are going to need to keep an eye on research and developments to see how things are going. $409 million of related acquisitions and integration expense was included in the earnings per share. So far, they spent $409 million on this expense. And that's why we see that in that earnings per share, why it missed 12 cents. We can see $409 million, an extra expense that they did not account for previously. So that makes sense. They're trying to do some acquisitions. So there are two things that there's two acquisitions that or three acquisition matters that BMY is trying to do at the moment. First, they're trying to close the Celgene transaction where they're acquiring the acquisition of Celgene. The second is they want to divest this Otacella brand that they have, and when they divest, right, they're just trying to sell off or get away from it. So these are the two things that's going on with BMY. Some other things to note is if you take a look at note 6 in the 10Q report, they are talking about restructuring. In October 2016, the company announced a restructuring plan to evolve and streamline its operating model. The majority of the charges are expected to incur from now to 2020, well, from 2016 to 2020, and they believe that range cost will be about $1.5 billion to $2.0 billion. And the main reason it's going to be so expensive is when restructuring happens, right? They're starting to lay off people, they're trying to change equipment and all this, right? They have to do all these contract termination costs. They also have to change equipment acceleration depreciations. They have to just change everything outright. At the moment, the charges of approximately $1.3 billion have been recognized for this action since the announcement. So they say this is going to go from 2016 through 2020. So they still have about a year. And that's, I mean, they're around their target right now of about $1.3 billion. Employee workforce reductions were approximately 100 and 300 for the 6 months ended June 13, 2019 and 2018. So we can see in 2018, they were actually laying off a lot more people. They laid off 300 in 2000 between June 30th, 2018 and 6 months prior to that. And this starting this June, they laid off about 100 people in the past 6 months. So for those previous tasks that we were talking about, there were no points given to that to Bull Solo or Darth Bear, just because those are things you guys should know. It's just information for the overall investor to know. Next, we're going to take a look at shareholder return. This company does have a shareholder return. They pay a dividends. I think last year they paid about $1.64 in dividends. And at the moment, they do not have a buyback program. But because they do have a nice healthy dividend, which I think was 3% yield with its current price, that's definitely better. When I saw the average was about 0.84%. So for that reason, Bull Solo gets another point, and that's definitely 3 points for Bull Solo at the moment. So the next thing we're going to take a look at is the company's debt. In this past quarter, this company took out about $1.2 billion resulting from the issuance of new notes in connections with the pending acquisitions of Celgene. So right, this company took out approximately $1.85 billion. I forget the actual number for this acquisition of Celgene, and this is how they distribute it, right? So this is pretty good to note. They have a floating rate due 2020 of $750 million. In 2022, they have $500 million again floating rate. But look at the percentage of the other ones outside of the floating rates. They have a 2.5% notes due on 2021 of $1 billion. Then 2022, they have 2.6% of $1.5 billion. And you can see this money is pretty cheap. They're borrowing money for on the low. So these notes are definitely going to get paid back. I wouldn't see why not. They're such low priced interest rates, right? 2.5%. The highest is 4.2%, but that's a 30-year note at 4.25%. That's amazing. I mean, it's pretty much the mortgage of a house. The current mortgage is what, like 3.2%. So those are definitely good numbers. But one thing to note is the reason they are taking out this huge amount of money is for the pending acquisitions of Celgene. So next, we're going to take a look at cash and cash equivalents. This company has about $30.4 billion of cash and cash equivalents available. One thing to note is if someone wants to read that, they're just like, oh wow, this company has a huge amount. Out of that $30.4 billion, $18.8 billion is based on the issuance of new notes. So in reality, they have a lot less than $30.4 billion. After we take a long short debt obligations, long-term debt, this company is actually positive net cash position of $5.4 billion. So that's actually pretty good news. The $5.4 billion is good after long-term debt and short-term debt. And this is only in cash equivalents and market securable. This is not counting anything else from the company's assets. So for that reason, I'm gonna have to give another point to Bull Solo, right? This company has plenty of net cash positions to be able to pay off its short-term debt and long-term debt, and this is just looking at liquidized money. Their debt is not that heavy. It's based on notes that they borrowed with such low interest rates, so you guys can understand why I would give a point to the Bull Solo. Next, we're going to take a look at an outlook based on analysts. So the first thing we're going to take a look at is earnings per share. So for this past year of 2018, this company reported about $3.01 of earnings per share. In 2019, they're going to estimated to report about $4.29. And in 2020, they're expected to do $6.13. So this is actually pretty good news. We can see the company is growing and is growing at a good pace. One thing to note, though, I am pretty shocked that this company has a forward PE ratio of of 8.08, and I think for a pharmaceutical company that's pretty low. So that's definitely a good thing. But that to me tells me that investors are scared about something. And the only thing I can think about that this company is scared of is one. Well, actually, there's many things. The first thing is, right, medicine in general. If another company can come up with the medicine better, then that's a big trouble for the company. The second is companies like in the pharmaceutical usually have a lot of legal matters going on, and that could be something that they're scared of. I know that they're pretty much half or their 10Q report was filled with legal matters. So that's something that I can see can throw off a lot of investors. But based on what we saw, 8.08 forward PE ratio for 2020 is definitely not a bad thing. At the moment, I easily would love to pay that. I think even anywhere between even a 10 PE ratio, right? 10 PE ratio will give this a 61 price. But at the moment, we still have to take a look at the company's financial documents in the next episode before we can actually take a look at that. But next, revenue this quarter was last year was 22.56. For 2018, they're expected $24.21 billion. And for 2020, no way they're expecting $42 billion of revenue. I mean, that's a huge jump. And I wonder if it's probably just going to be a one-time thing. And that's why the forward PE ratio for next year is so low. But they know after that, the trend might continue. And it might go back down to like 11, a forward PE ratio of 11. So that's one thing to know. Unfortunately, I can't see past this data. But because we see revenue increasing year after year, we see earnings per share increasing year after year, we're going to have to give a point to Bull Solo. So Bull Solo is definitely killing it with BMY. I wonder if Darth Bear, Darth Bear is going to come here strong, and it's not going to leave empty-handed. So one thing to note is Bristol Myers recently just said that they're going to decrease their 2019 GAAP earnings per share. The previous guidance was $3.84 to $3.94. They reduced this guidance by about 11 cents. So for that guidance reduction, we're going to have to give a point to Darth Bear. So one thing to note is, though, even though they decreased their GAAP earnings per share, they're not reducing, they're actually increasing their non-GAAP earnings per share. So what does this mean? This means one thing, that this next quarter, they have accrued extra amount of charges that is going to be most likely a one-time charge, and that's why it doesn't affect the non-GAAP earnings per share, but it is affecting the GAAP earnings per share. And the second thing is it actually increased because they probably collected more revenue. But the reason I'm giving it a negative point is every quarter you can't expect a different single charge, right? If every quarter you're doing a charge, at the end of the day, that random charge has become consecutively happening every year, right? This quarter, again, they missed GAAP earnings per share because they had that expense. And that's something, right? That's just a repeat happening over and over. And it's just a leeway for them to make it seem like things are going better. But if this one-time expenses are happening so constantly, then it's not a one-time thing. And for that reason, I had to give a point to Darth Bear. And also, Darth Bear can't leave here empty-handed. He'll be pretty upset. So I hope you guys enjoyed this episode. I definitely learned a lot about this BMY company. Usually I don't follow pharmaceutical company, but this is actually a company I've been following for some time in the trading, not in the investing. And I wanted to see what the company was about, and that's why I decided to take a look at it. But I think based on what I learned, I'm gonna stay into my technology, my inventory, retail store things I understand, because I hate not being able to pronounce these medicines' name. So next, I think I'm gonna take a look at HPQ, and some more. Earning seasons is coming, right? So earning seasons is starting right now, and I'm ready to rock and roll. So I hope you guys enjoyed the episode. If you did, make sure to post on the comments, give me a thumbs up, share it with your other investor friends. And if you have anything you want to discuss, feel free to post it in the comments. I'll gladly talk to you guys. And hey, you guys can teach me something, and hopefully I can teach you guys something. I'm here to continue learning, and I hope you guys are learning with me. So take care, guys. Have a good night, and see you next time.